Understanding Options on Stocks, Part 4, Spreads. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, website, and email address, and our phone number. And the source for this information was the optionsimple.com website. I wanted to introduce some new terms with options before we go on to the spread explanation. At the money means that you're buying an option where the strike price or exercise price, we'll use those terms interchangeably, is equal to the market price. So if the market price is 30, you're buying a 30 call or a 30 put. Strike price equals market. In the money means buying an option that is in a profitable position. For example, you buy a 50 call when the market price is at 60. You've bought the right to buy the stock at 50, sell it at 60, and make a profit. So in the money is profitable. Out of the money is not profitable. So you buy the 50 call when the market price is at 40. You have the right to buy at 50. Market price is at 40. You expect the stock to go up in value and eventually get above 50 so you can make a profit. Let's go on to the definition of a spread. A spread that we'll see in a minute involves two option positions. And another term we should mention is a sold option can also be referred to as a short option position. Because when you sell an option, it's the option buyer, the other party, that controls what's going to happen. Bullish and bearish, this is two terms that are general for the marketplace, but we can apply them specifically to options. Bullish means optimistic. There used to be the catchphrase for Merrill Lynch is bullish on America, on the TV ad. Bullish means optimistic, which means you expect prices to rise. If that's the case, you're willing to pay premiums, which we also call a debit transaction in options. A debit meaning you're willing to pay a premium because you expect a profit from the option position. That is, the profit you'll get from the option is more than the premiums that you're paying. That's a bullish position. Bearish, pessimistic, you expect prices to fall. In this case, you want to earn premium income from selling an option, and you expect that premium income to be your total profit because you do not expect the option position to be profitable. I'm going to jump over to Excel and talk about our long spread option example. Now, why would we want to do this option position? We expect high stock price volatility, but we're not sure in what direction. So there's some type of calamity or big event like the elections or 9/11 or the oil spill in the Gulf. Some big event you think will cause a lot of volatility in the market, but you're not sure in what direction. Well, you can benefit from that change and never take ownership of the stock, which means it'll cost you less money out of pocket by setting up a spread position, among others. So as a review here, I've put this information over here so we can keep the terminology straight. One option contract controls 100 shares. In my example, the common stock, the underlying common stock is IBM. The options expire in May. That's the expiration date. The strike price or exercise price happens to be $20 a share, and the premium that's being paid in both cases is $250, and we have to multiply that $250 by 100 to equal $250. Now, my example is not perfect because I have $250 listed for both positions. In actuality, they'd probably have different premiums, but I'm going to keep it simple for my example. So our spread position is we're going to buy a May 20 put option, and we're going to buy a May 20 call option. Put, right to sell, call, right to buy, and in both cases we're buying. So what's our break even? That's important to know in terms of strategy. Well, what would happen if the price went to 25? Well, we would exercise our call option and buy the shares at $20 a share, since it's less than the market at 25. We pay out $2,000. But keep in mind that we've paid $250 times 2 options, so we've paid out $500 for the option. And since the market price is at 25, we'd sell the shares at 25, getting $2,500 in the door, and we'd have 0 profit or loss. I'm going to put that in bold. We also have a break even if the stock price is at 15, because in that case we would exercise our put. We have the right to sell shares at 20. We get $2,000 in the door. Our total premiums paid again is $500, 2 options at $250 each. But the problem is we've sold something we don't own. We've sold the options, we've sold the shares here, 100 shares. Now we go out and we buy those shares at $15 so we can make delivery to the buyer that we sold to at 20. Those shares cost us $1,500 again, no profit or loss. So we actually have 2 break-evens on this long spread, 25 and 15. What's the most we can lose? It's our premiums paid. Because we own both options, we control whether they get exercised or not. If we don't exercise either option, all that we've lost is $500. Now, why wouldn't we exercise either one? Because it's not profitable. And specifically, if that stock price doesn't move above 25 or under 15, it's not profitable to exercise either option. So the maximum loss I put in red is the total premium. What's the most we can gain? Well, what if the stock price goes to 0? Well, keep in mind we've locked in the right to sell shares at 20, so we would exercise our 20 put option. We'd sell 100 shares at 20. 20 times 100 is $2,000. We paid out premiums of $500. That remains the same. But now, in theory, we can buy the shares for a market price of 0, and we'd end up with a $1,500 profit. So that's one way we can gain. On the other side, what if the stock price increases to infinity? Well, remember, we've locked in the right to buy the shares at 20 by buying the call option. We'd buy the shares at 20. We've paid out premiums of $500, and we can sell the shares for an infinitely high price, and stock prices in theory can go up forever. So our profit in this case is infinite. So the maximum profit from this option position is infinite. We can look at it graphically here. Here's our strike price at 20. That was the strike price for both option positions, 20. We found out we have a break even at 15, and we have a break even at 25. That was the information right here. Our maximum loss, let me eliminate this line. Our maximum loss, which is what we found when we had a price below 15, is $500, which is our total premiums. We found that up here. The most we can gain is infinite. The most we can gain is an infinite amount because we can sell that stock for an infinite amount of money. The most we can lose, 500. The most we can gain, infinite. And we also did the example right here where we said if the stock price went to 0, we'd have a maximum gain of $1,500. So in this range, in between 15 and 25, we're not going to exercise either option because it doesn't make us any profit, and we're just going to have the loss of our premium. So this option position is betting that we're going to have a price above 25 or below 15. That's the end of part 4. You'll see our essential courses on YouTube. Thanks very much. We'll see you next time.